Morning.
Have we seen the top in Treasury yields and the dollar? And if so, does this mark a positive inflection point for markets?
We're certainly getting closer to it. I mean, look, we've seen what by the end of this year, if the Fed sticks to its word and delivers another 100 to 125 basis points of additional hikes before the year's out, we're looking at roughly 4.5 percentage point increases in the Fed funds rate within a 1 year time frame, which is incredibly compressed, going by historical experience of previous rate hiking cycles. So yeah, I think we're getting close to it. The Fed funds futures curve has also adjusted significantly over the last 3 months. It's moved up by more than 150 basis points. So I think we are whichever measure you look at it, I think the amount of required rate hikes is probably coming into the peak of that is probably coming into view. So which is why I think the market is beginning to be a bit more optimistic. I think two things which brought out the optimism overnight. I think one was the pullback in the UK tax cut, and the other more important thing probably was the downshift in the US ISM numbers. I think that clearly indicates that the economy is slowing. And when you put that together with where the market pricing of Fed funds is, that's what's feeding into the optimism we are seeing overnight.
All right, Aninda, so listen, to tie it all together, one, you're not quite ready to get back on the equity train. We're close, but not just there yet, which is why you're still underweight equities. You like strong dollar, you just told us that. Cash, let's talk about that, and also short duration fixed income, which is kind of close to cash, right? We're in this unusual position where we've been told, the conventional wisdom has been for months now, that look, in an inflationary environment, holding cash is probably the worst thing you can do. In this particular situation, though, because the yield curve is inverted, whether it's cash or whether it's, let's say, T-bills, those are starting to look pretty good, are they not?
Yes, it is. So, I mean, cash is probably not trash anymore going forward, especially dollar cash. I think I would emphasize that on a currency-weighted basis, or currency-adjusted basis, rather. I think that's an area which still looks pretty good. It's an extension of the overall long dollar story, really. And in addition to that, Martin, I would point out that TIPS yields are in positive territory. The real yields are in positive territory for the first time, and sharply so, since before the global financial crisis. So on an inflation-adjusted basis, at least adjusted for break-even inflation, you're getting paid a real positive compensation there. So which is why that's the emphasis we have on the short duration part of the fixed income market, as well as on real yields and so on.